and that's kind of open invitation. You just kind of sign up on the websites and you get to listen to kind of fantastic speakers from around the world talk about issues relating to monetary policy and financial stability. And lastly, we're planning to organize a training school for people who kind of want to develop expertise to, I guess, maybe they're already working in a central bank, or they want to kind of move to a central banking career or a financial regulation career. And that's likely to be in kind of late February, March time. Okay, so that's a little bit of an introduction about the center, and I hope you'll forgive me for doing that. So let's kind of kick off with the talk today. And I thought we could break it up into 3 questions, really. So the first one is the straightforward question about what effect has COVID-19 had on the global economy. So I'll run you through kind of various charts and kind of data points on this to kind of give you our best guess about the kind of footprint that the pandemic has had. And I'd like to talk about the policy actions that governments around the world, central banks have taken, and give you, a little bit of a take in terms of what impact they've had. How well designed have these policy actions been? And then I'll end the lecture with a few thoughts. These are kind of high-level thoughts on some of the challenges that policymakers face and will face in the years ahead. So if you have any students out there who are looking for thesis topics or, or just have an interest, I suppose, in the world of central banking, hopefully this will kind of give you some kind of some clues as to kind of the big issues that are on central banks' agendas going forwards. So I hope that sounds okay with you all. And as we said at the beginning, let's have a Q&A at the end, I suppose, is the easiest way to do it with an online lecture. Let me start with this question about what impact COVID-19 is having on the global economy. Of course, sitting in our respective countries, the United Kingdom and India, COVID has had I'd say, a dramatic public health impact. That's been the first order effect of what we've seen. Our respective countries, I think, have suffered extremely. That's pretty clear. There's also an economic impact of the pandemic, which is, potentially a long-lasting thing, and that's really what I'd like to talk about. We really saw an unprecedented collapse in GDP. So GDP being gross domestic product, think of that as the total output produced by an economy in any year. The level of GDP collapsed around the world in 2020 in a fashion that's really unique. We haven't really seen anything like this, at least going back to the Great Depression. That might be the closest analogy, the Great Depression being the collapse in the world economy in the 1930s. Since then, we've seen a very strong recovery, I'd say, but an uneven one. So that's the kind of headline. Let me kind of unpick that for you. I'm going to show you some data, mainly from the IMF, who I think have done a very, very good job of kind of harnessing, bringing together information in terms of what's happening around the world at the moment. So this is the data I'm going to show you are taken from a publication that the IMF put out. I think it's 4 times a year, or it might be twice a year, perhaps I've got that wrong, called the World Economic Outlook. And this is their kind of flagship document that contains their forecasts of what's happening in the world. And this is from their July 2021 World Economic Outlook. So the first thing I'll highlight on this table with a lot of numbers on it is the top row, so world output. So this is the IMF's attempt at computing global GDP and what's happening to global GDP from one year to the next. And these estimates, they'll probably still change going forwards because even after the event, we still revise data. But our best guess as of now is that world output contracted by 3.2% in the year 2020. Now you might wonder, is that a big number or a small number? So one point of comparison is, if we go back 10 years, there was, the most dramatic of events, I think, in my lifetime was economic event until now was something called the global financial crisis of 2009. This is the crisis that followed the collapse of Lehman Brothers. And on that occasion, world output fell by just 0.1%. It was almost flat in terms of world output. Now we're seeing a contraction of 3%. If we zoom in on what's happening in the UK and India, because I guess that will be of interest to people in the audience here. So the UK, the contraction was enormous. It was almost 10% year on year. So GDP is 10% lower than it was the year before. And in India, the number is kind of in excess of 7% contraction. So our two countries suffered a lot from a health perspective, but also from an economic perspective. Let me show you some of that data in a different way. So now I'm going to plot the time series of world GDP growth. So this is the annual growth in world output as calculated by the IMF. And yeah, it's kind of annual percents on the axis here. And you can see it kind of wiggles around, and then there's this dramatic fall at the end of the sample. So this global financial crisis that I mentioned after the collapse of Lehman Brothers, that's the data point I've highlighted on the charts here, where it was almost pretty much zero, the change in world GDP. And now we've seen, a much steeper contraction. We can also kind of break this down using the data the IMF produced in terms of what's happening to advanced economies versus emerging markets and developing economies. So advanced economies is the blue line here, emerging market economies, the orange. And you can see, the picture is pretty much a very steep contraction across the board, with a somewhat steeper contraction from the perspective of advanced economies. The blue line has fallen even more, right? I want to show you this in a different way again, which is kind of this. I think this is quite effective, and these are again charts you can find from the IMF's website. So this kind of geographical map of the world, the idea is that the colors of each country represents how fast they're growing from an economic perspective. So greens are kind of fast growth. Any country in red is having a recession. That's one way to think about it. And you can see if we kind of go all the way back to 2018, most of the world had kind of healthy growth, 0 to 3% or above that. There are a few exceptions around the world, Argentina, for instance. But by and large, it was kind of a picture of across the board growth. And you can kind of wind that forward a year to 2019, and you get a pretty similar picture. There's some of the colors have changed a little bit, but the predominant shade is green, or different types of green. Now, if we go into 2020, hopefully this gives you a sense of the breadth of the contraction. So across almost every country in the world, we've seen GDP not just falling, but crashing. And that's shown by the red, all the reds on the chart here. If I'll give you one interesting statistic from where I'm sitting, so in the UK. So we have pretty good historical data in the UK going back many centuries. And it turns out, like as an interesting fact, that the contraction in GDP in 2020 was the largest we've faced, going all the way back to 1709, right, which is quite astonishing when you think about world wars and things like that have occurred during this period. So it really gives you a sense of this is an event the like of which we've just never seen before. Now, this is so far I've talked about the kind of crash that happened, and that, we'll talk a little bit about the causes of that as well. I'd now like to talk about, cast our minds back I guess it's about a year. maybe 9 months. And there was a big debate about how is the economy going to recover from this crash point. And economists used, I think, some kind of slightly jarring jargon about, what the shape of the recovery be. Would it be a V-shaped recovery, so a very quick bounce back in GDP? Would it be an L shape, which is, almost like a permanent hit to the economy? There were various other letters that were used to describe the shape of the recovery, but this was the kind of big debate a few months back. And the debate is really about kind of bringing some economics into what I'm telling you here. It really relates to a term that economists use called hysteresis. That's I should have asked actually a little bit about the background of the audience here. So if I'm pitching this at the too easy or too difficult, I do apologize. But the idea of hysteresis is, in a nutshell, that kind of shocks to the economy can have permanent effects. The state of the economy today, the level of GDP, is what we call history dependent. It depends on kind of the shocks that have driven us to where we are today. Another way of phrasing that is that recessions can leave permanent scars on the economy. Why is that? People talk about kind of frictions in labor markets very often as an issue of people. A lot of people lose their jobs and they kind of permanently, maybe their skills depreciate. They find it hard to re-enter the labor market. You won't go back to the same level of GDP anymore. You'll be kind of permanently at a lower place. If you want to see this in kind of graphical form, so the charts below, these are little charts I've just made up. So think of the red line here as the level of GDP, right, over time. And it's kind of bumbling along. And then we get like some massive COVID shock. So this is the contraction I've just illustrated. And you can contrast two views of the business cycle. They're really at the heart of this, what will the recovery look like question. So the chart on the right shows you how most economic models are built and the assumptions that are built into them, which is basically that the economy is this self-correcting system that if you kind of push it, it'll come back to where it started. You won't have a permanent effect on the level of GDP. Sometimes people talk about trend versus cycle when they're describing this view that there is a trend that's exogenous, and any shocks which comprise the cycle, they may be persistent, but you'll eventually come back. And the hysteresis view, by contrast, is that you get these permanent shifts in the trend. You never actually catch up to where you would have been. So that's really the heart of the issue here. And the debate is, would COVID and the kind of scale of the shock we're seeing, would it lead to these kind of permanent scarring effects on the economy? And that's foreshadowing what I'm going to say when I come to the policy debate, but it underlies why the policy response to COVID has been just so aggressive. People were very concerned about this prospect. So let me kind of tell you a little bit about what has actually happened and what the IMF, from this trough points, and what the IMF are now expecting for the year ahead. And it's kind of a good story. So it's very robust growth. I've highlighted the kind of projections part on this slide. So you can see for kind of world GDP, which we've been focusing on so far, we've got this 3% contraction in 2020, and they're expecting 6% growth and almost 5% growth in 2021 and 2022. Now, that's kind of well above where we'd normally think of as trend growth, which is about 3.5%. So they're expecting a very strong bounce back, the IMF. That's true in the UK as well. The projections are very, very strong. And it's also extremely strong in India. So that's the kind of outlook that people are expecting. Chart shows you the same information, this time from a Bank of England source. So the chart on the left shows you profiles of GDP growth in some different countries, with the recovery in China being particularly strong, red line on the left-hand charts. The euro area looks distinctly less strong, I would say, in terms of recovery so far. It's also true, though, that the recovery has been uneven. So on this chart, which I'm afraid is also from the IMF, basically asks, how close are we to catching up that previous trend? And their analysis is, it's actually uneven in that space. So whereas advanced economies are kind of not a million miles away from the trend they would have reached, for emerging markets, because the trend tends to be steeper, there tends to be more rapid trend growth. If you exclude China from the set of emerging markets, you end up with a kind of a 6% gap. I think this is, this is on average running through to 2024. So this is based on their forecasts. They think there's going to be a 6% gap relative to where the set of emerging markets would have got to without COVID. So this is evidence that this is having a kind of a somewhat of a scarring effect on the economy. Okay, a couple of other bits, I guess, of adding a little bit more analysis to this. So I think one question we could ask is, how has the experience in the pandemic so far, how is that compared with lessons from pandemics in the past, right? Now, there wasn't a huge economics literature on past pandemics, I think it's fair to say, but it is a literature that kind of grew quite quickly when the pandemic started. And the episode that people have really focused on is the 1918 influenza epidemic, which was the last kind of truly kind of global event of this nature. And some of the studies of that are kind of interesting. So there's a study by Robert Barrow, who's like one of the most preeminent macroeconomists, growth macroeconomists around, and he found that the typical country that experienced this 1918 influenza pandemic saw GDP hits of around 6% and consumption hits of around 8%. So these are numbers that are, they're not so dissimilar to what I showed you earlier. There's a similar study by Correa et al. That finds that manufacturing output fell substantially more than that. And there are also papers out there that kind of ask the question, suppose we had a model of how pandemics and the economy interact, and we kind of reran the world, we reran the kind of 1918 epidemic in today's global economy, what would happen? And they also came out with numbers in the region of 3 to 6%. It's interesting, though, that the other epidemics we can think of in recent years, SARS, Ebola, and so on, they had negligible economic impacts, even in the countries that were affected by them. So this isn't kind of a completely watertight story, I think, at this stage. There's a lot to learn still. The other thing I was going to ask is, we could look back at the historical record for macroeconomics and ask, is what we're seeing now, how different is it, particularly the recovery? How different is it to other cases where there have been really massive shocks to the economy? And there's an interesting, it's almost like a blog article that economists at the Federal Reserve Board put out this year that basically goes through the historical record, a large number of countries, post-1945, I think this is, and they find, I think, something in the region of like 30 severe recessions, where severe is a case where GDP fell by around 15%. And the red line on this chart actually shows you what happened to GDP in the period after this very severe recession. You can see that the effect is permanent, pretty much. That's the red kind of maroon line on the chart marked severe. But then they do this interesting thing where they also kind of say, well, suppose we then partition those severe recessions into cases where there was also a financial crisis and cases where there wasn't a financial crisis. What they find is that the kind of that permanent impact tends to be associated with financial crises. So the blue line is the case where the financial system was okay, even though you had this collapse in the economy. And that kind of bottom line, though, which is the black line and the black dots, which is a forecast now, is that the COVID experience looks to be even stronger. The COVID recovery, I should say, looks to be even stronger than the average historical severe recession that wasn't accompanied by a crisis. So that's a little bit of good news. And it's, again, links to, or, why is that? And I think my answer would be, well, the policy response is one reason why we didn't end up on one of those much more severe, persistent paths this time round. It doesn't look like we are going to be. Maybe very briefly, because this was mentioned in the introduction, this question of like, is there a health economics trade-off? This is a slightly aside chart, but I'll walk you through it very briefly. You've no doubt come across this kind of debate, is it true that if we kind of put in place more stringent lockdown measures, the economy suffers? And at one level that feels kind of obvious, and it kind of must be true in the very short term, that if you kind of lock everything down, as long as that lockdown is severe enough, it must be having an economic impact. I think that's not debatable. But if you kind of average over a little bit of time, it's kind of less clear that that trade-off exists. So this is a chart from some economists at the World Bank this time, where they plot deaths per million of the population in the COVID episode. So that's the horizontal axis, against the hit to GDP growth in 2020. And you can see, it's not a tight relationship by any means, but it is a downward sloping, significant relationship. So it's actually the case that countries that have suffered more from a health perspective, that have had higher death rates, have actually also had bigger economic contractions. So that kind of suggests that it's not such a simple, it's not so simple as there being an underlying trade-off here. And it's also true for studies that look back at the 1918 flu pandemic. They also find little trade-off in terms of cities that put in place much more stringent measures. I guess what the mechanism is, that contains the kind of spread of the pandemic, and you don't need to put in place even more kind of dramatic measures further down the line. So that's, so the jury is kind of still pretty mixed on this, I would say. All right, let me turn to the policy part of this. And I've kind of hinted a little bit at where I'm going already. Well, my bottom line really is that I think the quick rebound we've seen and the benign outlook that's in the IMF's forecasts is undoubtedly true in significant part, I think, to the really aggressive and really broad policy actions that governments around the world, central banks around the world have taken. I've heard this described as flattening the economic curve. People sometimes talk about flattening the pandemic curve, and this is the limiting the impact, mitigating the impact on the economy. And I think I would also argue that it feels to me like lessons learned from 10 years ago, where the response to the global financial crisis that followed Lehman Brothers was often very, very slow, too small, particularly in terms of fiscal response, where it was actually the opposite. We very quickly put in place austerity measures. So it feels like lessons learned, that's what I'd like to say. And let me just briefly kind of walk through for you the main actions that have been taken in terms of, I think of there as being three kind of core areas of macro policy these days. There's monetary policy, there's macroprudential policy, which is about the safety of the financial system, and then there's fiscal. Start with fiscal, because that's really been where the main action is, undoubtedly. And the scale of, let's call them discretionary fiscal policy responses. So by discretionary here, I mean the response that isn't just the one that's baked in through things like automatic stabilizers, where unemployment benefits go up if there's more unemployed. Here, I mean actual actions that governments have taken to spend over and above those automatic responses. The IMF calculate that these have exceeded 20% of GDP in advanced economies, and around 10% of GDP in emerging markets. These are kind of numbers are unheard of numbers, I would say. It's been particularly true in the US, where the response has been enormous. I think you should think of this response as really trying to provide social insurance rather than trying to boost aggregate demand. So, the textbook version of fiscal policy is often described as, maybe aggregate demand is falling in a recession, and the idea is to spend a lot to bring aggregate demand up. That's the kind of Keynesian idea. That's not really what's happened here. It's been more about kind of keeping households and businesses afloat during periods of lockdown, providing them with liquidity, stays on debt payments, this type of thing. This chart just shows you the scale of the responses. If you add up those two bars for advanced economies on the left, you get a number in excess of 20%. And emerging markets, you get a number around 10%. So what impact has this had? Well, it's always hard to nail this precisely, but we can look at things like, how have bankruptcies in the economy, so business failure rates, how have they evolved this time around compared to other recessions? The black line is what's happened this time around. I think this is advanced economies, actually. So failure rates of businesses have actually fallen, whereas normally in a recession, they'd of course go up, which is quite incredible. This chart shows you, again, I think this is advanced economies, but the response of households' disposable income. And you can see that normally income collapses persistently in a recession, whereas this time round, in aggregate, the household sector has kind of retained lots of income. There's a paper that's very recently published that was presented at the Jackson Hole conference that you can download from the internet by, I'm going to mispronounce this gentleman's name, but Gourinchas, I believe, and co-authors. And they try and kind of build a model to actually analyze in a slightly more scientific way the impact that these policy measures have had. And they found that, the kind of quick summary of their paper is that the failure rates of SMEs, so small and medium-sized enterprises, small businesses, would have been around 10 percentage points higher had it not been for the fiscal policy measures that we've seen. So we would have had a collapse or a jump in business failure rates, and we've prevented that from happening. They also find, interestingly, that the fiscal policy response was very, very poorly targeted. Maybe this is inevitable, but almost 90% of the funds dispersed went to firms that actually didn't need those funds. So what we saw was like an across the board, lots of firms can have liquidity. There wasn't the ability to kind of tailor those liquidity support actions. And so it's a very inefficient policy in that sense. We've prevented a catastrophe happening, but at probably a very, very high cost. And this is just a chart from their paper, kind of looking at, I think it's by country, what the blue lines, or perhaps it's green, are, the failure rates we would have expected without policy, and the orange lines are the failure rates we actually saw with policy. So I'd encourage you to look at that paper. It's a little bit technical, but it's very, very thorough. Turning to monetary policy, I think for me, I find it kind of useful to differentiate three categories of response that we've seen from central banks. We've seen central banks cut interest rates where they can. For a lot of central banks, they didn't have the capacity to do this because interest rates were already very close to zero. So the cuts we saw were very small. That's the first thing. Then we've seen expansion of what's called asset purchase programs, or what's more commonly known as quantitative easing, or QE. So this is where the central bank effectively prints money to buy usually long-term government bonds. And the last category is where we've seen much more novel policies where the central bank has provided money, printed money again to buy private sector assets. So things like corporate bonds, commercial paper issued by private companies. Central banks have even lent directly to private companies. So these are things that are kind of almost unheard of in the central banking world. I think I'll just skip through to this slide. So in terms of the impact that that's had, this is a measure of financial conditions that the IMF produce and publish. You'll find kind of many similar versions of this. What these measures look at is kind of how easy or tight are financial conditions around the world. By financial conditions, that means if I want to raise money as a household or as a company, how easy is it to get credit? What are the terms of the credit? How expensive is it? That sort of thing. As the line kind of goes up, financial conditions are tightening. So you can see, on the left-hand side of the chart, there was a very marked tightening in financial conditions during the 2008-2009 global financial crisis. Zooming to the right-hand side, you can see that when the COVID crisis initially struck, there was a jump in financial conditions. There was this very marked tightening. Central banks responded by kind of opening the monetary floodgates, printing lots of money, buying lots of assets, removing risk from private sector balance sheets. And the effect of that was to prevent, I think, a further tightening in financial conditions. So I'd say that's been another important part of the response. And very briefly I'd say macroprudential policy has been kind of less important in this response case. It's definitely been the third tier, I'd say. But what we have seen is, we forced banks and other financial intermediaries to kind of build up capital buffers after the last crisis. Central banks basically cut those buffers in various different ways. And they also forced banks to conserve capital, not paying dividends to their shareholders, kind of keeping the capital within the bank to kind of put them on a kind of a more secure footing to handle the risks that they were facing. And it's pretty hard to judge what effect that's had independently of all the other actions that have been taken. But it is, just look at the left-hand side of this chart, the thing marked domestic bank lending. It is the case that kind of bank lending has kind of held up. So it's actually even increased during the COVID crisis, whereas in the global financial crisis, that was a credit crunch where bank lending fell, the pink line on the slide. Okay, and then so that's the kind of success story, right? From my perspective anyway, we had this kind of huge three-pronged set of actions that prevented the global economy from what was a very steep recession from being really a catastrophe where GDP stayed very low or even fell further. The price of that really is in these two charts here. So the chart on the left shows you public sector debts. This is for the UK. You'll see similar pictures for a range of other countries. And the bulge you can see at the kind of right-hand bit of the charts that's starts in 2020 is the effect of the pandemic. So we've built up an enormous stock of public sector debt. It now exceeds 1 year's GDP, so 100% of GDP. There'll be a major issue going forwards about how that debt is paid off, if it is. The chart on the right shows you a similar thing, this time for central bank balance sheets. So I mentioned that central banks have been printing lots of money and buying lots of assets. This is the effect of this. This is for the kind of leading central banks. I forget exactly what's included in the G4, but it'll certainly be the Fed, the ECB, possibly the Bank of Japan, and maybe the Bank of China, I'm not entirely sure. But either way, there's this kind of huge increase in the scale of central bank balance sheets. And we can talk about what risks come with that in the Q&A if you're interested. So just to conclude the talk, and I hope I have a few minutes remaining, I just wanted to say a few words about the challenges that I think lie ahead. And I'll break it down into one slide for fiscal policy, one for monetary policy, and one for macroprudential policy, just so you have an idea of what's coming. So I would say, unsurprisingly, for fiscal policy, the main issue really is what strategy to adopt to handle this enormous stock of debt that's been built up, right? Do we try and pay it off over generations? Do we immediately switch to austerity, which is what happened after the global financial crisis, where, arguably that contributed to a very slow recovery? So there are some very hard questions ahead. Now, it is the case right now that global real interest rates are extremely low across the board, have been for many years, but are even lower now than they have been historically. So even though the level of debt is very, very high, the actual cost of servicing the debt is very low right now because the interest rate is so low. Now, for some economists, I've heard people argue, very preeminent economists have argued that if the interest rate is lower than the growth rate of the economy, mathematically it's true that you can kind of roll over the stock of debt indefinitely. You never actually need to pay it back because it will shrink as a share of the economy through time. But I think from my perspective, the risk to that strategy of really just kicking the can down the road of never thinking about paying it back is that we can't assume that interest rates will stay low forever. It's perfectly possible that we see a spike in market interest rates on government debt. That's one thing that could cause that is if inflation increases more persistently, and we could see the Fed tightening policy that would ripple through into interest rates on government debt going up. So there's a lot of risks, I think, in the strategy of doing nothing and just assuming that we can roll over debts indefinitely. It's also true that one of the reasons where governments are able to finance their deficits and debt positions so easily right now is that central banks have bought lots of government debt. I showed you that chart of central bank balance sheets that have spiked upwards. So, we're in this kind of slightly uncomfortable situation where governments are reliant on central banks to a degree of kind of holding lots of their debts and kind of rolling that debt over. Again, what could cause that to break down? Well, if inflation were to increase persistently, central banks would need to kind of adopt a different strategy and tighten monetary policy, and that would then have a ripple effect, a dramatic ripple effect back to government's ability to finance these deficits. I think there's a lot of risks in terms of the inflation outlook here. And, I would also say, there are a number of other really significant risks on the horizon, for example, relating to climate change, that are going to require fiscal capacity to address these risks. I don't know, financing sustainable investments and that sort of thing. So the question is, do governments still have the debt capacity to actually handle these other risks? So that's some thoughts on fiscal policy. I'd be very glad to talk about those further. Monetary policy, briefly, I think, from my perspective, I think I would actually say that the policy environment facing central banks is probably the most challenging and uncertain that I can remember in my lifetime working in central banking. We've seen big jumps recently in inflation. The question is, how persistent or transitory are these jumps going to be? I think there are issues about, does monetary policy still have the levers to influence the economy in the way it has done in recent decades? Interest rates are very, very low. Can't really cut them much further to stimulate the economy. I'm also concerned about whether central banks can tighten aggressively enough if they need to, given the knock-on effect this will have for governments. The Fed is now beginning to talk about tapering its asset purchase program. You know, the last time that happened, it caused a big tightening in financial conditions, and which had, you know, very large effects on emerging markets and capital flows. You know, that's a huge risk, I think, in the year ahead. And this is all happening at a time when central banks have kind of revised their policy framework. So you've probably read that the Fed have moved to this flexible average inflation targeting framework, which is a lot more complex. And I think it's unclear whether that move is kind of helping them or hindering them at this moment, particularly from a communications perspective. And really my last slide then is, you know, the challenges for macroprudential policy, which I think just to reiterate, I don't think was really tested in this crisis. It was really the third kind of leg, I'd say. One issue that, you know, did go wrong is that as soon as the COVID crisis hit, markets around the world completely seized up. And so that includes kind of some of the most liquid core markets in the world, like the market for US government debt. You know, suddenly trading collapsed in that market. So I think an important question for macroprudential policymakers is what measures they need to take to kind of prevent that happening again, to increase resilience in global financial markets. Beyond that, there are, I think, fairly straightforward questions about at what pace should we try and rebuild buffers in the financial system. These were cut after the COVID crisis started. When is it time to start rebuilding? Should we go to the same place, or have we learned something with COVID about how much resilience we really need in the financial system? And that, I think that links to some other kind of key risks that are kind of lurking on the horizon. Debt levels in the corporate sector are very, very high. We could end up seeing a wave of bankruptcies in coming years, which would kind of create losses for banks. I think it's an important risk. Asset prices are really, you know, sky high at the moment. If asset prices were to collapse, what effect would that have on banks? And then there's the kind of risk coming back to fiscal that's, you know, we end up seeing a fiscal crisis, and that would have knock-on consequences for the banking system. That's often referred to as a doom loop, where a fiscal crisis then triggers a banking crisis. That sounds very gloomy, but just to give you some kind of sense of the challenges that I think lie ahead. I think that's my last slide. So why don't I stop there, hand it back to you, and happy to take your questions.
Thank you, Prof. Aikman. It was a wonderful speech. Now the floor is open for question and answer. So we have got a couple of questions here. Shall I read it out for you?
Yeah, are they in the chat, or should I look at them myself? But yes, if you can read it.
Yeah.
It's probably easier if you read them out.
So we have a question from Mr. Chirag, and he asks that as per the IMF data, and considering China's better abilities than India, how can one explain India's projections to exceed China's by over 2%?
Oh, I couldn't quite understand that. The sound wasn't great. But I think your question was about comparing China's experience with India's experience. Is that right? Yeah. I'm not an expert on this. I should have said my focus is more in terms of UK, US, European economies. So apologies if I misspeak here. I guess my sense is, you know, I showed you data where the contraction in India when COVID started was a lot more severe. The kind of fall in GDP was a lot more severe than what we've seen in China. When you get that kind of collapse, you would expect also a rapid bounce back from that. My sense, though, is that China is the kind of country around the world that has most quickly, at least according to their official data, has most quickly kind of returned to trend growth. So, they took very, very drastic public health actions initially when the crisis hit. It's a country that's large enough to be, self-sufficient in a number of dimensions, and that's allowed them to kind of resume growing at a very quick pace. So I'd say kind of a large part, the kind of differences in the the experiences of India and China will relate to kind of how severe the pandemic has actually played out in both countries.
Thank you, Professor. And there's another question from Vishaka. She has asked, as discussed, the pandemic has undoubtedly increased the gap between the poor and the rich significantly in every country. However, from the IMF data, it seems evident that the emerging economies have suffered less compared to the developed ones in terms of output. Do you think that this will increase the gap between the poorer countries and the richer countries?
Poor countries and advanced economies, I see. That's a very interesting question. It seems quite a nuanced picture. So I did show you, I wonder if I could kind of zoom back through my slides quickly. So I think I showed you this chart in my presentation where maybe this is what your audience member is referring to, where, the blue line, the fall in GDP for advanced economies is larger when COVID struck. And that's certainly true, undoubtedly. It's also true that trend growth in emerging markets is faster. So I also showed you this line, which gives you a different perspective. Sorry, this chart here, where, if we think about, what's the gap between, where countries would have expected to be if COVID didn't hit versus where we now think they're going to be. That's what these bars are showing you. And the gaps are actually bigger for emerging markets and bigger still if you cut out China from the set of emerging markets. So it's a 6% gap. That reflects the fact that you'd expect growth to be faster in emerging markets, full stop. So it's a slightly nuanced picture of maybe a less severe contraction initially, but more of a scarring effect in emerging markets. That's at least what the IMF data are pointing to. So, how you measure inequality is an issue that's always kind of fraught with difficulty. But this, it would appear to paint a slightly negative picture about, are we having more convergence as a result of COVID or less convergence? I think I could also point to, some forces that may be more prevalent in the years ahead. So there'll be possibly more protectionism, more of a desire from countries to be self-sufficient. So you could see globalization going into retreats. And I would say that wouldn't be good news for emerging markets as well, and this story of kind of convergence and catch up. So I think I'd be kind of slightly negative about what effect will COVID have on income inequality across countries in the years ahead.
Thank you. There is another question from Kirti. The question is, in countries with a possibility of a third or more waves, won't the focus of fiscal policy on debt have to wait?
So if I understand the question, then so it's, given the possibility that we're going to have further waves of the pandemic, which seems inevitable at this point, what does that mean for the strategy of kind of paying off fiscal debts that have been built up? I think that's a very, very good question. I think that's just, the answers to these questions are never easy. That's why they're very good ones. But I'd say I would agree with the hint in the question that should give us pause before kind of putting the brakes on and trying to kind of move into a phase where we're trying to pay off debt and kind of return interest rates to kind of more normal levels. It's important to kind of keep policy in a very loose, have a very loose stance of monetary policy, fiscal policy, I think, for some time ahead until we know we're clear of these issues we face. I would agree with that.
Thank you. There's another question from Arya. She asks, there have been discussions about universal basic income even before the pandemic. Do you really think that we can consider universal basic income as a policy measure at these times?
What a good question. Your audience members, I think, are raising very good points. What do I think about this? I guess, like, when you're trained as an economist, right, you think about efficiency as being one of the criteria for policy actions. And I think on any measure, a universal basic income isn't like an efficient policy, because you'll end up paying money to people who don't need it. So it's, in terms of the goal of kind of raising incomes at the lower end of the income distribution scale, it's kind of a very expensive way of doing this. The debates about introducing a UBI, universal basic income, as the questioner says, predate the pandemic, and they relate to things like the impact of technology on jobs going forwards. Will more tasks be automated by machines? Will it be harder for people to find work going forwards? Will we therefore need another way of ensuring livelihoods? And that's a very big question. I think it's too early to kind of make a big call on that. It kind of strikes me that we possibly don't need to, there's possibly a lot of other things we could do that wouldn't involve going all the way to a universal basic income, that would nevertheless have a very dramatic effect on income levels of the poor and kind of providing greater social insurance. We've actually been doing a lot of these things in the last 18 months. We've been very successful, I think, in terms of designing transfer schemes that have provided income to people who've lost their jobs. So I think personally, I'm going to give you a guarded response here, because I haven't really thought through the issues enough. But my sense is I'd rather we kind of start with those, exploring kind of more targeted ways of raising income levels, raising tax rates up the income scale and providing more transfers to people lower down, rather than moving straight to a universal basic income, which feels like a very blunt way of achieving, a very laudable aim. I hope that's clear.
Thank you, David. We have a question from Devji. He asks, are the inflated asset prices here to stay, considering the huge amount of liquidity released by central banks all over the world, a lot of which went into financial asset markets? Or will they decline slowly over time as interest rates are hiked in small increments? Or is there a sudden collapse in asset prices waiting to occur?
Wow, this is more on my territory, and I think it's a good question. And I hinted in my last slide, that was a risk, that asset prices do look sky high right now. Whether you're talking about equity prices, they've looked high for a long time. It's also true if you look at like the price of corporate debts. It's another way of saying the kind of the yield on corporate debt is very low, so the price of corporate debt that investors are willing to pay is very, very high. It's also true in housing. I know less about the kind of Indian case, although I could kind of hazard a guess, but it's certainly true in the UK, the US, Europe, that the price of housing is kind of sky high relative to measures of fundamentals. Now, I would say the kind of main reason for that is that global real interest rates are extremely low. So for your kind of students who have taken courses in asset pricing, you can think of like the price of an asset, so a share or housing, as being like the present discounted value of the income that asset generates. So the dividends that you get from owning a share, or the rental income you'd get from owning a house and renting it out on the markets. So if interest rates are very low, you attach a lot much higher weight to future income streams. So that pushes up asset prices. And the effect can be really dramatic. So framed like that, you could say, well, the prospect for asset prices are then inextricably linked to the prospects for real interest rates, okay, or the prices of government debt assets. There are a lot of studies out there, these are pre-COVID studies mainly, that kind of point to underlying structural reasons why interest rates are so low around the world. So issues related to demographics, I guess weak investments opportunities, so low productivity growth, these types of things, which tend to be very slow moving structural forces. So if you put weight on those arguments, that would be a reason to think, you know, the most likely case is that interest rates around the world will stay very low in the period ahead, and that will keep asset prices very high. That said, you know, the question kind of hinted at, you know, might asset prices collapse? And I think from a policy perspective, we should be kind of thinking that that's a serious risk and making sure that the financial system could handle a collapse in asset prices. That would seem to be a prudent policy stance right now. So running stress tests, say, of banks to make sure that even if house prices collapse a lot, you know, that's not going to screw up the banking system. That's the type of thing.
Thank you. We have a question regarding the shape of the recovery. Should we expect a K-shaped recovery in the near future? As we see, industries are going up while consumer industries are still not performing, giving us a picture of demand. What might be the long-term impact recovery pattern?
That's a very good question as well. Yeah, you can think of a K-shaped recovery. So that's, you know, the jargon of a K-shaped recovery is the idea that you have like a divergence. I can't really draw it with my fingers on the screen. I don't know if you can see that, but the idea is, you know, for some parts of the economy, the recovery is very rapid and they do very well, and you can quickly get back to the pre-trend path. Whereas for others, it's much more drawn out, you know, you go the wrong way, so hence the K. We've spoken a little bit about that from a cross-country perspective already, where, you know, it's likely that there'll be more scarring effect on some countries than on others. Going forward, I think that's likely. I think within a country as well, it's fairly inevitable, I think, that, you know, we are seeing, even before the pandemic, I sense we were seeing very dramatic sectoral shifts in the economy. If you walk down a high street in the United Kingdom, if any of you visited here, you know, you'll see a lot of like old stores that have been in existence for, you know, decades, hundreds of years in some cases, closing because of internet shopping affecting kind of shopping patterns and expenditure patterns. You know, that's an effect that's gone into kind of overdrive, I'd say, in the last 18 months. So I think some of those trends are likely to be very persistent. And if you're in an industry that's being overtaken by these technological changes, those are the industries that will end up experiencing the kind of the bad side of the K-shaped recovery. So I do think that's an inevitable prospect. Yeah.
Thank you. I think we can have this last question probably. How far, this is from Darshit, how far do you think the creation of soft money out of the thin air, combined with the kind of preferential beneficiary allotment of that money, has impacted the revival stage in any economic recovery, not just COVID, but any boom or bust? And also, what is your take on Wall Street, Main Street debate fueled by very loose monetary policy?
I didn't quite understand the first part. So the question asked about soft money.
Yes.
Is that the expression? That's not an expression I would use very often. I'm wondering what they refer to exactly. Is this I'm trying to kind of guess the reasoning underlying the question. So sometimes people distinguish between inside money and outside money, where outside money is something created by a central bank, that's like a hard claim, whereas inside money is money created by the financial system. I'm not sure if that's where they're heading, or whether they just refer to the large quantitative easing that we've seen around the world as as soft money. I'm going to take the questioner to mean can these kind of huge quantitative easing programs that central banks have engaged on, effectively printing lots of money, has that been successful? Has this helped the recovery? And what does it mean going forward? So I think my view on this is a little bit nuanced. So I think the impact of central banks' money printing, I think, depends a lot on the state of the economy when it's happening. So I think most of the time, the impact can be quite minimal. So it will, at least on the real economy. So if a central bank buys government debt, it will affect, interest rates on government debt. It will push up asset prices. But we haven't seen a very large impact flow back from that to the real economy, so to spending in the economy, to investments, these types of things. So I'd say it's been underwhelming as a policy tool from that perspective. That said, I think when financial markets really seize up, like they did in March 2020, I mentioned that even the market for US government debt, which is the most liquid market in the world, effectively collapsed at that point. So it was at risk of collapsing. So I view, in that state of the world, it's extremely important that the central bank can step in and act as a buyer of last resort, or a market maker of last resorts, as it's sometimes referred to. So I think this is, for me, it's a tool that kind of is really for extreme emergency situations. It shouldn't be part of the regular operating framework of central banks. But when markets really truly seize up, like they did in March 2020 or in the global financial crisis, it's very important that central banks do have this tool. I'm not sure I answered the question there, but hopefully it was a useful answer nonetheless.
I think with that, we can wind up the Q&A session. Thank you very much, Dr. David. On behalf of NMIMS and Sarla Anil School of Economics, I thank Professor David Aikman for accepting our invitation and delivering such a wonderful and insightful speech. Thank you, David.
It's a great pleasure. And thanks to all of you for joining and for your great questions as well. I hope we can keep in touch.
I also thank Dr. Ramesh Bhatt, Vice Chancellor, SBKM's NMIMS deemed to be University, for his extensive support. I thank Pro Vice Chancellor Dr. Sharath Menskar for his participation. I thank Professor Amida Vaidya, Director, School of Economics, for her relentless support and enthusiasm. Without her, this event would not have been possible. I thank Ms. Meena Saxena, Director, International Linkages, Dr. Arvind Atulya, Senior Partnership Advisor, King's College London, Ms. Dolan Mitra, International Student Recruitment Manager, King's College London, for showing interest in this event and supporting us throughout. I also thank faculty members, students, and non-teaching staff for their active participation. A special thanks to Ms. Carol Mascaranis, Marketing Executive, NMIMS, for her immense support and help. Thank you all.
Thank you.
Thank you. The host, you'll be made the host by default because your voice was not there. The sound was not audible, so I think you will need to enter meeting.
Okay, I'm going to log off now. Very nice to engage with you all, and please keep in touch in the future.